Hi everyone, good morning. My name is Deepak Bisht, and today we are going to start with leverage buyout question and answers. Previously, we have discussed about the leverage buyout. I have actually made an introductory section. So I would recommend you to go through the introductory session first and then attend the question and answers. So let's get started with our question and answers now. So these will be the basic question and answers. And basically, these questions would be a plus point for you guys if you know all these questions. These would be helpful during your interview time, and you are likely to get these questions if you have already had a banking internship or if you are working with a group like financial sponsors that works extensively with private equity firms. And yes, most of the times leverage buyout is done by private equity firms. And you need to know the basics, but it's important to understand how the different variables affect the output and how and why a PE firm would structure a deal in a certain way. So just keep that those things in mind. Uh, and Okay, all the very best. Let's get started with question number one now. So question number one is about walk me through a basic leverage buyout model. So for this question, I would like to revisit what we discussed previously. I'm sharing my screen. I'm sharing my Excel. So previously we have discussed about leverage buyout. So if you are to walk through a leverage buyout model, so first of all, these are the steps. So we assume the transactions, we look into the sources and uses of cash. We do the financial projection. We prepare a debt schedule. We assume we calculate our exit assumptions, and we calculate our return on the capital. So in the transaction assumption step, what we are going to do is we are going to calculate the purchase price. We are going to calculate how much portion of debt or equity should be there. We are going to calculate we are going to calculate or estimate the transaction fees and financing terms. After that, the sources of cash. We now need to arrange the money. So where would the money come from and how it would be used. That's the second step. In financial projections, we are going to project the financials of the target company, the income statement, balance sheet, and cash flow for 5 to 7 years usually. And after that, we are going to prepare a debt schedule so that how much debt and how much interest are we are going to pay and how much time we need to amortize the loan completely. After that, we are going to calculate our exit assumptions. Exit assumptions means at what price we are going to exit out of the investment. See, in an investment, return is recorded when you exit the investment. So from a pri- uh, private equity perspective, this is an investment. You are purchasing a company and you are selling it out. Your product is not stocks. Your product is not uh, any FMCG product. Your product is actually you are creating a company. You are revamping everything. You are taking for ownership, and for ownership, you are actually using debt. Of you are actually raising debt first. Then you are acquiring the company, and then you are uh, fixing everything wrong in the company, then you are selling it out, and then you are booking your profit here in this phase, in this step number 6. And here in step number 5, you are actually estimating at what price we will sell the company at after 5 to 7 years. What should be the enterprise value to EBITDA ratio multiple, and then you will calculate the returns for equity investors. So this is what a leverage buyout model. These are the steps involved in the leverage buyout model. And so assumptions page, but we are assuming the purchase price. This would be the our purchase price, and out of 600 millions, 65% is going to be our debt and 35 is going to be our equity. This sums up to be 100%. And we are able to acquire a 65, a $390, $390 million loan at a rate of 7%. And we are going to pay back the loan. We are going to amortize at a 10% interest rate and at a 10% rate. And every year we actually have to make an installment of $339 million along with the interest payment. And along with the interest payment. And we are assuming that the target company's revenue is going to grow at a rate of 7%. And if you can see here, the projections would be here. This is the projections. We are assuming that the revenue is going to be at a rate of 7%. We are assuming that the EBITDA margin is going to be 20%. And this is the exit multiple. This is exit multiple means we are going to assume the exit assumptions that at a rate of exit multiple at a time, exit multiple 9x of EBITDA actually. So 9x of EBITDA is the exit multiple, and the tax rate is going to be 5%, and depreciation would be 5% of EBITDA again. So these are the assumptions. Afterwards, we are going to forecast the financials of the target company. Then we are going to calculate the free cash flow. We are going to calculate the free cash flow portion. Then we are, and interest component will help us to forecast our interest expenses here. That schedule will help us to calculate our interest expense. And then we will go to the summary part where we are going to calculate the return calculations. The summary part is where we are going to calculate the return calculation. So this is the enterprise value. So enterprise value was calculated using the EBITDA, and 9 times of this exit EBITDA. So I have simply done what I have done is here is 90.4. If you multiply with 9, it's $810 million. So the initial investment was they have actually bought the company for $600 million, and they are able to create an exit enterprise value of $810 million. And $810 million enterprise value, we have subtracted the any remaining payment, any remaining principal payment. So we will get the equity value. So equity value we have driven here, we have calculated here. And using these parameters, so exit enterprise value and exit value, we have calculated the MOIC. So MOIC means multiples of capital employed. So multiple on capital employed is simply that the exit equity value is 603 million and we employed $210 million of our own. So this is the capital employed, return on multiples of capital employed. And if we were to assume how much was the internal rate of return, which is an annualized rate of return. So this is a multiple and this is a return. This is percentage. This is going to be percentage, 16 percentage, and this is 2.87 is the multiple throughout 5 years. So this is a multiple of 2 point. So we have basically done is we invested 210 and the rest of the money was taken as a loan. So this was not our money, this was debt. Our money was only 210 million, and this 210 million, using this 210 million, we have multiple on invested capital. We have created $603 million of equity value again. So we have generated a multiple of 2.87 simply. And internal rate of return means that if we were to calculate an annualized rate of return, because this is a multiple only, this is this much times of x, this is this much time x, and internal rate of return it at, if we were to invest this money 210 million somewhere else, at what percentage would this money would have given us 603 million? That's internal rate of return, and this is 16.2 16 point 16.27 percentage rounded off. So this is what internal rate of return means. So let's get back to the presentation. This is what walk me through an LBO model means. So basically, leverage buyout is when an investor usually pays a private equity firm to buy company mostly using a borrowed money, and rather than paying for it all in cash, the idea is that the company's future profit will be used to pay off the debt, and when the investor sells the company later, they earn a strong return on the smaller equity investment, and that's why we were actually forecasting the target company's financials, and this is how the all the calculations ROIC and IRR were calculated. I hope this actually explained everything. And in plain summary, just figure out the purchase detail and the financing mix. See where the money comes and goes to, and update the company's financials to reflect the new ownership and debt, and forecast how the company does over time and how fast it can repay debt, and estimate what the investors earn when they sell it later. So that's pretty much it. So that's an LBO model, the introduction of an LBO model. Okay, so let's move to question number two now. So question number two is about why would you use leverage when buying a company? And leverage just means using borrowed money to help buy a company instead of paying for the whole thing with your own cash. And the main reason the investors use leverage is to increase their returns so that they can control a larger company using less of their own money. And simple example is that imagine you want to buy a company for $100. If you use only your own money, you will pay $100 full. But if you borrowed $60 and use your 40% of your own money, then you are using leverage. And later, if the company grows and it's worth 150, so um, you pay back the $60 loan, and you are left with $90. And since you have invested only $40, so you actually made more than your investment, because and there is also secondary benefit also because the investor do not use all their own money on one deal. They still have funds left to buy other companies. So leverage helps them spread their capital across multiple investments, which can increase their overall return. So leverage means borrowed money, and it boosts return by reducing how much of your own money you need to invest, and it also lets you invest in more deals at once. So if you remember, we actually calculated in our basic Excel questions, Q&As. So if you are including debt in your schedule, rate, your cost actually reduces. And if you are actually not including debt in your schedule, your cost increases. So if you remember this part, if you have not I mean, you are new to the channel, I will recommend you to go to the previous slides, previous videos. So this, if my cost is reducing, then my profit is increasing. If my cost is increasing, then my profit is reducing. That's pretty much the that's why leverage is actually introduced in a leverage actually is benefit it actually benefits the investors. So uh, okay, let's move to question number three now. So question number three: what variable impact an LBO model the most? So this is a very good question. And in an LBO model, which is basically when an investor buys a company mostly using borrowed money, a key factor, the I mean, there are few key factors that have biggest impact on how good the investment is going to be turns out to be. So first of all is that the purchase price. So what you pay when what are you paying? So the purchase price is the very first uh, key point here. Is this is like buying a house. If you overpay at the start, it's harder to make any good return later. And a lower price means that you start with a better deal and your potential profit is higher. So that's the purchase price. That means. And exit multiples mean at what price are you able to sell it. So this is how the investors can sell their company for at the end, and usually based on the multiples of its profits, EBITDA multiples. And if you can sell it for a higher multiple, then you actually bought it for so your returns go up. So if you buy it cheap and sell it pricey at a higher rate, so your returns will go up. So purchase price and exit multiples together are the biggest drivers of return. And just like buying and selling a house at the right time, amount of leverage also, how much debt you use, this is also an important aspect along with the company's performance, how the company is going to perform, because you are going to focus the target company's financials also. So using more debt can boost returns because you are putting in less or less of your own money, but it also increases risk. Means that too much of debt can make it harder for the company to handle downturns to make the payments. So leverage is a powerful but risky lever in the model. And if the company and finally, if we talk about the company's performance matters. Things like revenue growth and profit margins and EBITDA margins. If the company grows sales and keeps strong profit, it generates more cash to pay the debt faster and increase its final resale value also. And in short, the price you pay and the price you sell have the biggest impact, and the amount of debt affects the returns and risk. And the company growth and profitability determines how much value it can build over time. So, purchase price, exit multiples, and the amount of leverage used. I hope this was clear. Let's move to question number four now. So, question number four is how do you pick purchase multiples and exit multiples in a leverage buyout model? And the purchase multiples and exit multiples are basically ways to describe how much you are paying for the company and how much you are expecting to sell it, and relative to its earning. So usually using something called the EBITDA multiple. And now to decide what multiples to use, investors don't just make them up, they look at the real world data. So, first of all, they will look at the comparable companies and they will look into the past LBO merger and acquisition transactions. They will test a range of multiples. Means since no one can predict the future, you do not pick one number. So, you show a range of purchase and exit multiples using a sensitivity table, and that helps you to see the investment return would change if the market conditions improve or worsen. And and lastly, sometimes it's based on the target return. And in some cases, you are using LBO to value a company, and you might work backwards to set the exit multiple or purchase price to hit a specific target return (IRR), which is known as. That's more of a valuation exercise than a real deal assumption. In short, you pick the purchase and the exit multiples. First, you will do is you will look into the market data, then you will test a range of scenarios, and you will adjust your long-term target investment returns on the basis of those. So that's pretty much it about question number four. Let's move to question number five now. So question number five is about what is an ideal candidate for a leverage buyout. So ideal candidate. And I mean, an LBO or a leverage buyout means you are buying a company mostly using borrowed money. So just like if you take out a big mortgage to buy a house, the company itself has to generate enough steady cash to pay up the debt over time. And that's why most important thing in an ideal LBO candidate is a stable and a predictable cash flow. So the company needs to be consistently earning enough to cover interest payments and repay the debt. Uh, let me just tell you what makes a good LBO target company. So there should be steady and low risk business. So if a company's revenue should not swing widely over year to year, for example, utility companies like with reliable customers is better than a startup whose income depends on trends. Stability reduces the risk of missing the debt payment. Low ongoing investment needed means that the if the business constantly needs to spend a lot on new equipments or upgrades, means capital expenditure, it has less cash to pay off debt. So ideal companies don't require heavy reinvestment and keep running. Cost cutting or of efficiency opportunities. So private equity firms often look at businesses where they can improve margins, maybe by cutting unnecessary costs, streamlining operations, or improving pricing. That actually boost profitability and increase the company's value. Strong management team means that good management is key. You want experienced leaders who can execute improvements in managed growth while handling the company's debt obligations and tangible assets also. So having valuable assets like equipment, property or inventory helps because those can be used as collateral for the loan. And in short, an ideal LBO candidate is stable, cash generating business that do not require a lot of reinvestment and has a room for cost improvements and is run by a solid management team. The most important factor, though, is steady and predictable cash flows because that's what pays down the debt. I hope this was clear. There is no better way to explain it any further. So let's move to question number six now. So question number six is, how do you use an LBO model to value a company, and why do we sometimes say that it sets the floor valuation of for the company? So an LBO model can be used not just to analyze an investment, but also to estimate how much a private equity firm could afford to pay for a company while it still earns a certain return. And that's I mean, first of all, what we need to do is start with the target return. So private equity firms usually have a target return of let's assume the 20 to 25% of target internal rate of return, target IRR, and then they start working backwards. So in an LBO model, you can work backward in Excel to find the maximum purchase price that still gives the investor the that target return. So in simple terms, if we buy this company for X amount of dollars, use this much debt and sell it for Y amount of dollars in 5 years, what price would give us 25% of return? So the number becomes your LBO valuation. That number becomes your LBO valuation. And why it's called a floor valuation? If you think about it, why it's called a floor valuation? We call it a floor valuation because it represents the lowest price range at which a buyer could make the deal work financially. And usually, strategic buyers like companies in the same industry can afford to pay more because they expect synergies. For example, cost saving or new customers from combining businesses. Private equity firms don't have those synergies, so they typically offer less. That's why it's called a floor valuation. And in short, you use an LBO model by setting a target return and back solving for the price that meets it. The price sets a floor because the private equity firm generally cannot pay as much as a strategic buyer. I hope this was clear. Okay, so let's do one thing. Let's stop our today's session here only. Let's conclude it. And in the next session, we will start with question number six, seven onwards. All the very best learning. Thank you. My name is Deepak Best, and I will see you soon.